You can learn more listening to a podcast today than you can going to a 4-year university. And so the ability to go out there and brand yourself, to market yourself, to come up with any idea and to have it become a business that actually comes to fruition tomorrow has never been easier. And so if you're stuck right now and you're listening to this podcast and you're like looking for that next thing, I'm telling you right now, the opportunity is happening right now. And if this does not fucking excite you, this game truly is not for you.
Welcome to the Master Passive Income Show. My name is Dustin Heiner, and I'm here to help you quit that JOB, that just over broke job, by investing in real estate so you never have to work a job again. Today, I'm actually in San Diego hanging out with a super awesome dude that is a real estate investor as well as a podcaster and invests in boutique hotels, over $85 million in assets, and is just crushing it in the real estate space as well as fun with podcasting as well. I have Rich Summers on the show. Hey, Rich, thanks so much for being here, man.
Dustin, I appreciate you coming all the way out from Nashville and hanging out, man. Thanks for having me on your show.
Yeah, this is so fantastic. So when we first got connected, I was looking at everything you're doing, and I was like, this would be fun to do it in person, because we were thinking about doing it, virtual. But at the same time, it's not the same when you're talking to somebody in person, face to face, and then also coming out in San Diego.
It's not, man. The in person is great because you get to build a genuine connection. And one of the hacks of having your own podcast is you get to have conversations with people that are a lot smarter than you, and you never know what doors are going to open up for you from those relationships. And in person, you really build genuine relationships that you really don't via Zoom.
But you know what's funny too? I actually don't use Zoom almost anymore. I do phone calls now. Like if I'm just going to meet somebody, if I want even a sponsor call, we have sponsors that come to the show. I don't do Zoom anymore. It feels so impersonal to me. It feels like a phone call is so obviously in person, face to face, by far the best. But not everybody's going to be able to do that. But man, for some reason, a phone call. Have you ever felt like that? Have you felt like Zoom gets really impersonal?
There was a while, beginning of last year, where I was doing a lot of calls, even capital raising calls with investors via phone. But I went away from that this year, and I'm really doing the Zoom calls because it's a little bit more face to face. Get a better vibe for them, better feel. But then you get to do a screen share and really show the properties and the business plan and the aesthetics. And so I feel like I used to feel that way, and then I kind of shifted back. So I go back and forth.
Well, definitely, if you have assets that you need to walk them through, show them hey, this is the property, this is all the numbers and stuff like that. Well, now I definitely want to jump into the idea of boutique hotels, or having the ability to turn something. Let's say it's a small apartment complex, let's say 10 units, and then the idea of boutique hotels is coming on strong because there are a lot of people that are doing it well. Tell me a little bit about what that actually, what does that mean to you, a boutique hotel?
Boutique hotel by definition is anything that's less than 100 units and independently ran, non-franchised, non-branded. It's not going to be a Marriott, a Hilton, or Ramada Inn. It's independently ran and less than 100 units. For us, we're targeting hotels that are less than 50 units and under $10 million in purchase price, because it's estimated that 25% of the boutique hotels out there are owned by retiring baby boomers. But a lot of those boomers own assets that are kind of valued below $10 million. And a lot of those assets haven't been renovated in decades. They're not utilizing any technology. A lot of them might even just be relying on a direct booking website, and that's it. And so because they're not on these OTA platforms, they're not utilizing technology, and their properties haven't been renovated, it gives us a massive opportunity to go in there and not only buy them at a discount, but add tremendous value. I mean, when I'm talking 2x, even 3x in the value in a short amount of time, 12 to 18 months, through the boutique hotel model. And that's why I pivoted over to it about 3 years ago.
Because you were doing apartment complexes before.
I was doing apartments, and I was investing in Airbnbs. And if you think about it, a boutique hotel is really the combination of two.
Totally.
I had the investors from the apartments, and then if you can run a portfolio of 10 Airbnbs, you can run a smaller boutique hotel. The same guest communication, the same fundamentals between housekeeping, and then you bring in your investors on the multifamily side, and I was already set up.
I remember growing up, and you still see them. Like if you drive down any downtown area of a city, you'll see small, they're called motels, is what they're used to be called. They might still be called motels. Is that what I'm thinking of? Like a smaller types of you said under 100 units, but can a 10 unit, 15, 20 unit hotel or a motel that it was, can you turn that into something like this? Or does it, because when I say here boutique too, it kind of seems like it's much more glamorous or much more, high-end type of stuff. Like, what are your thoughts with how we can turn something that's not very, very pretty into something better?
Yeah, you could turn any motel, hotel out there as long as it's independently ran into a nice boutique hotel. And boutique hotel doesn't need to be luxury for us. We are taking an old, tired hotel and we're renovating it. We are making it higher end. We are making it luxury, and we are putting in nice finishes to our renovation, but also our design. The modern traveler today, they don't like the branded stuff. And so the days of, I mean, look at the restaurant industry, for example. The millennials, the Gen Zers, they're not going to Chili's, they're not going to Applebee's, they're not going to these like famous branded restaurants anymore. They instead are going to these restaurants that are like one-offs, that are well designed, because face it, I mean, I talked to demographers on the podcast, and demographers are labeling the Gen Zers, the millennials, as the sharers. They want to go and have these experiences at these restaurants, at these hotels that are Instagrammable, and they want to share it with their friends on social media. They want to share it with their friends via TikTok. And so that's really what we're going after with the boutique hotel model. And so you're seeing a lot of these bigger branded hotel chains like Marriott, like the Hiltons, they're starting to catch on to the trend. And so now they're starting to acquire and develop smaller boutique hotels that if you stay at these properties, you wouldn't know that it's a Marriott or a Hilton, and they'll have a collection of them. And so that's really what we're going after with our particular model, is we're appealing to the modern traveler.
Because Hilton, Marriott, all the big companies, they have their own sites. People go and they maybe go through Priceline or, some big booking agency. So you said you would not necessarily have that because, I mean, you could have your own site where people can register. Do you depend on like Airbnb, VRBO? How do you find clients to come in and stay at your place?
So direct booking is one. So you have a direct booking website. And then we'll go on all the OTA platforms. So the OTA platforms are, Expedia, Priceline, Hotels.com, Booking.com, Airbnb, Vrbo, all the above. We'll get in as many channels as possible because it's the more eyeballs, the better, right? And you are going to pay a commission. You're going to pay a channel commission, typically 15, sometimes even 20%, depending on the OTA or the channel out there. But the goal is to get those clients and those customers into your own ecosystem. And so we'll collect their email addresses when they stay at the property through our Wi-Fi systems, right? So in order for them to log into the Wi-Fi, not just the guests that book, but all the guests that are in that hotel room, they're going to get into the Wi-Fi at some point on the property. And so now we collect their email address, we collect their phone number, and then we put them into a drip campaign, and we'll send them emailers, marketing material to get them to come back and direct book at another one of our properties.
That makes a lot of sense. So when I buy real estate, I buy it for cash flow. So talk to me about number one, cash flow, but number two, if you can't manage it or you can't have somebody else run it, you got to do it yourself, which I don't want to do it. That's why I like master passive income. I want as much passive income as possible. Other people doing the work, especially experts. But it sounds like that's a lot of work, having a hotel, making sure that you're doing turnover, making sure you have the amenities, all that sort of stuff. Is that, and does that eat into your cash flow, or how does that work out?
It is a lot of work. Like hotel investing is probably the most active asset class within commercial real estate. This is going to be more so than self-storage, industrial, mobile home parks, multifamily investing. It is going to be more active. But because of that, there's higher cap rates. And so if you can dial it and you can dial down your operations, we self-operate here. It gives us full control. It gives us the ability to move quick. And if you can dial in the operations, you have an opportunity to make a lot more cash flow than you would in a lot of these other asset classes because of it.
Did you have to build out that team, like find the right cleaners to the right hotel staff that's going to make sure everything's run? Like, that doesn't sound very easy.
Yeah, so we self-operate, and so on my leadership team, we have an office here in downtown San Diego, where we're recording this podcast right now. And on the leadership team, on the operations side, we have a revenue manager, and revenue manager basically is going to be in charge of all the revenue that's coming in for these hotels, making sure that we're on all the proper OTAs, we have the proper marketing set up, we're using the right SEO. We'll do influencer stays with our Instagram handles for the properties. We'll bring in like influencers with bigger audiences. We'll give them stays to come stay at our property and do content and do Instagram collabs, which will bring in more people. We'll also do promotions. So like with the LA fires that happened a month ago, one of our local properties, we did a discount for anyone that lives in LA that's affected by the fires. So there's always promotions going on based on season, based on holidays, etc. But all that stuff will bring more demand to the hotels. We got a marketing director, and then we also have a hospitality director that's going to basically be operating and managing all the day-to-day. So we have on-site staff at the hotels, front desk, we have housekeepers. Some of the smaller hotels, like we have a 10-unit boutique hotel where we have no front desk. we don't need a front desk. We just need housekeepers, and maintenance can be done third party only as needed if we have a job. And then we also have a team of full-time VAs in the Philippines, and those VAs do a lot of the back end stuff. They will do a lot of the guest communication with guests checking in, guests checking out, a lot of the accounting on the back end, and that sort of thing. And then the last thing I'll say is we have, obviously, because this is a very intensive business, there's a lot of money being moved around, right? The guest might request, hey, they want something for their room. And so boom, we're getting an accommodation for them. So that way their stay is enhanced. And so because of that, we have a lot of accounting and bookkeeper and all that sort of stuff that does all the back end stuff.
Man, that's fantastic. Now, how many units do you have total?
We currently are acquiring our 5th boutique hotel. And that will be 5 hotels in this fund. I'm going to put about 10 hotels in this current fund before I close it. Okay.
Okay. So for everybody listening, a fund means he has investors that come in and invest in these deals with him, so they don't have to do all the hard work on their own.
Correct. Yeah. We have about 100 investors right now, all amazing individuals, passive investors. These are business owners, high income earners, doctors, attorneys. We got a couple well-known real estate CPAs. We have a WNBA player all-star, and we have a professional skateboarder, but it's a very diverse, investor community. And we're just getting warmed up. But the goal is to put 10 hotels into this first fund. I'll close it at that time. And, we're acquiring stuff that's West Coast, very, very well-located assets in the West Coast, California specific, either on the water or off the water in A+ locations. And the reason I say California, a lot of real estate investors, long-term investors, multifamily investors, they go into these more landlord-friendly areas. They tend to.
I'm in the Midwest. I love the Midwest. Great properties.
Like Florida, like Texas, like Arizona, because you don't need to deal with tenant rights, and the landlord-tenant laws are just a little bit friendlier for real estate investors. I understand that. Now, with us, with the boutique hotel game, we are thinking quite opposite, because we are taking advantage of the tightening Airbnb regulations that are happening in a lot of markets around the country. We saw what happened in New York City. We saw what happened in San Francisco. We saw what happened in Los Angeles. I live in San Diego. They recently introduced very heavy short-term rental regulation in San Diego a couple years ago.
It doesn't affect you?
Well, what it's doing is this phenomenon that's happening across the country is bringing more demand from the Airbnb visitors to the boutique hotels. People are still going to travel.
The regulations don't affect you.
They do affect us.
Oh, they do.
They bring more demand to our properties.
Sorry, in a negative way. It doesn't negatively, because I'm just thinking, okay, if somebody has a 4-unit and they're putting it 4 units in Airbnb, and then regulations come in and says, hey, you can't do, short term, it has to be 30 days or more, then you got to turn a midterm or whatever. But that doesn't affect you then. Is it?
No, this benefits us.
But
this is the phenomenon I noticed 3 years ago, and this is why I pivoted to hotels, because Airbnb is going away in all markets around the country right now, and it's going to continue to happen. And as that continues to happen, people are still going to travel. It's just now, instead of renting Airbnbs, they are going to be renting boutique hotels. And because these things are valued like commercial real estate, the more I can increase the income and the more I can increase the NOI, the more these things are worth.
How does it not negatively affect you, though? Meaning, because I'm just trying to understand, how the regulations stop mom and pop, say they have one house that's Airbnb. Maybe they can stop a house from being a short-term property, which is totally fine. But if you have 10 units, how is regulations not stop you from being short-term? How do you class? How do you classify it as a hotel?
We're not buying multifamily properties and operating them as hotels. We're buying hotel zone properties. So these properties that we're acquiring have commercial zoning, and they're specifically zoned for hotels.
That's what it is. Okay.
So these are zoned for nightly rentals. And so when a city imposes Airbnb regulations, those regulations are restricting residentially owned properties, single families, condos, multifamily, like a multifamily apartment, even if it's a 60-unit apartment complex, that is zoned residential, right? That is not zoned hotel. So unless you have the hotel,
regulations will affect them negatively.
So unless you have the hotel designation, we won't look at the property.
Got it. So because it's commercial, but they can't stop you because it's a business. That's what we're doing. Is we're running a business just like a hotel. Okay, that makes sense. But then it's positively affecting you because you still have the people that are traveling. They still need a place to stay.
Exactly. And then the other phenomenon is this. There's tens of thousands of Airbnb investors out there. They're all looking for that next thing because as more markets become more oversaturated, as more markets continue to regulate, all these Airbnb investors are looking for that next thing. it's the next natural progression for all of them. When I go to these real estate conferences, all the Airbnb investors out there are like, yo, Rich, I cannot wait to buy my first boutique hotel. And I'll go up there on stage and speak on hotel investing. And there's going to be all these other asset classes out there, Airbnb, short-term rentals, and all this stuff. When I go and speak on boutique hotels, it's like the most popular panel of the entire conference. All these kids are like, yo, Rich, I cannot wait to do my first hotel. So I believe in 3 or 4 years' time, it's going to be the next big thing. Right now, there's not any books on it. There's not many podcasts on it. Like my podcast, I do talk about boutique hotel investing, but like there's not much out there on it. And so I believe in 3 or 4 years, it's going to be the next big thing. So I'm going all in on it right now.
Man, that's awesome.
Yeah.
I could definitely see it. I could definitely see it, especially when I travel. I don't really like going to big chains at all. Like they're big boxes that they're all the same. So I like variety. And I'm not a millennial. Like I think I'm Gen X. Is it? Yeah, I think it was Gen X. I'm not Gen Z, but I'm Gen X. And I realized too.
What year were you born?
79.
Okay.
Yeah. So more than likely.
79, you should be millennial.
Am I?
Yeah.
Okay. But with me knowing where I'm at, I like it. I start realizing probably other people like this idea too. So I love it. But I want to also jump to, in 2019, you told me you cashed in everything to go down this path. Like you didn't start, let's say 50 years ago investing in real estate or however long, but like it was relatively, like you closed everything down. You started doing this. Talk to us about how'd you get started doing in this? It's, multifamily first.
Good question. And by the way, Oscar, look up. I want to make sure that I want to fact check this. I want to make sure we're talking the right thing. Look up the millennial generation.
I hope I'm not a millennial. I'm going to offend every millennial, but anyways, I hope I'm not.
How I got started in real estate investing. So I was a full-time government employee for the FAA as an air traffic controller for 11 years. I was taught like most people from a young age. My mom is an immigrant from Taiwan. And both of my parents were middle class, but I was taught from a young age to go to school, get good grades, go to college, and get a job. And so for the most part, that's what I did. And I worked some sales jobs in college. I sold cell phones. I sold cars. I did very well doing that. And I wanted to go sell commercial real estate, but I graduated in 2008 with a degree in economics, and I wanted to sell commercial real estate. I interviewed at CB Richard Ellis, Grubb and Ellis, and they were like, yo, dude, we love your hustle. We think you'd be great at this, but this is not the right time to get in the industry. 2008 was happening. And so I found myself in a car lot selling cars, wondering, what am I going to do? I stumbled into a job as an air traffic controller, and you made pretty decent money doing it. I actually really enjoyed it. It was fun. And I worked LA Center 6 years. I worked 5 years at SoCal Approach, which is here in San Diego, doing radar, sequencing planes, arrivals, departures in and out of all the airports in Southern California. And I got to a point 11 years in where I felt stuck. I didn't feel like I was growing, and I was looking for that next thing. And so I took all I had in my name, which was a 401k, and I used that as my seed money to get into my first couple real estate deals.
Did you cash it out? Or
I cashed it out.
I did too. I cashed it out.
Yeah, I cashed it out. I had about 330K in there, and paid the penalties, the taxes, and I rolled that into my first 2 real estate deals, 11 units in Cincinnati. I still own that deal today. And a 32-unit building with 2 partners in Indianapolis. And we bought that one for 1.1. 2 years later, we sold that for 3.1. And that was my first big win in the real estate space. And shortly after I bought that second deal, I was out of money. And so I started a podcast on the multifamily side. I started interviewing multifamily investors that were a lot smarter than me, and brought on some mentorship. And I learned how to underwrite bigger deals, how to raise private capital. I co-GP'd a couple larger multifamily deals, and that was my first taste of what it was like raising money. I did it with an experienced operator. We still own those assets today, the Arbors Townhomes in Greenwood, North Carolina, and then also Timber Creek, also in Greenwood, North Carolina. And both of those assets we still own today. And that was my first taste of what it was like doing bigger deals, right? And so anyways, that's kind of how I got started. And then in 2022, I was still doing Airbnbs on the side. I was doing some multifamily stuff, and I was building out my short-term rental kind of management arm to manage my short-term rentals, but also short-term rentals for third-party owners. So I already had the management arm in place. And that's when I was like, dude, let's go try a boutique hotel. Let's see what it'd be like. And so we did a 10-unit boutique hotel up in Northern California that's beachfront. We bought that for 1.5 and some change. The seller had never exceeded $180,000 in gross revenue. It was a mom and pop seller. They had owned it for 18 years. And we bought it for 1.5. They had bought the property 18 years ago for 1.9. And so with all the appreciation in
Well,
California,
they don't have any revenue coming in.
they
So
didn't.
wow.
No, so they sold it to us for a haircut 18 years later. And we took the revenue from 180 to 600. We bought the property for 1.5. It appraised 12 months later for 4.5. We 3x the value. And that's when I was like, I'm going to go all in on this model. I started the fund. And now we're acquiring our 5th boutique hotel, which we'll be closing on next week. And I'm going to put 10 hotels in this fund, close it, and then I'll start another one.
Is it normally a commercial loan? You just raise capital, get a regular 5-year commercial loan that you have to get for these properties?
Seller financing is what we always look for on the front end. If not, we'll go bridge on the front end because we're buying underperforming. So these assets don't have stabilized NOI to support the debt service coverage ratio. So we'll typically go seller financing or bridge on the front end, and then we'll renovate the properties. And then once we stabilize them, 6-9 months, generally 9 to 12 months of stabilized income under the new model, renovations plus our operations, then we'll refi a perm debt. If you love real estate investing, passive income, and tax benefits, but don't have the time, my company, Summers Capital, is buying boutique hotels right now. We source the deals, we renovate the properties, and we even handle all the day-to-day management, making it truly hands-off for our investors. If you want to learn more to see if we can help you, visit summerscapital.com/invest to book a call with our team. Again, that's summerscapital.com/invest. Now back to the show.
What type of return do you think somebody would get? They said, okay, you know what? I really like what Rich is talking about. I have the idea. I've done Airbnb in the past. Let me just go ahead and find a 10 unit, 5 unit, whatever, just, like a smaller unit with all the work that I have to put in, obviously decorating it, furnishing it, making sure that's ready for people to come in. But it seems like the revenue is going to be pretty high because as opposed to Airbnb, it seems a little different, right? Even though you're going to get people coming in from Airbnb. Well, let me ask you the question rather than assuming. Is the revenue better than an Airbnb house or one-off place that you get, or is it same nightly rate that you would normally pay?
It depends on the Airbnb and it depends on the boutique hotel, right? So I have a luxury Airbnb in Scottsdale that is 8 bedroom, 8 bath. It has a guest house, pickleball court, volleyball court, has a gym, speakeasy, and that thing crushes. It does last year it did $738,000 and it's a single family home, right? It's pretty good. And so we also manage other short-term rentals that are severely underperforming, right? And so it just really, really depends. But I would say this, generally speaking, if you do the boutique hotel right, you are going to get a combination of both a ton of appreciation, right? Like where else are you going to 3x a commercial real estate asset or even 2x?
Oh,
It's
yeah.
very hard to do that.
It's very hard.
So you're going to get a combination.
Well, especially you said that one you bought, the first one was $160,000 in revenue. You brought it to 600 in revenue in a year?
180 to 600. We more than 3x'd it.
That's absolutely insane.
Yeah. And so I'll give you one more. We bought, this is the most recent one we acquired. We haven't bought a hotel in 11 months, by the way. This is the first one in 11 months. We say no to hundreds of deals before we say yes. But this particular asset was built in 1988. It's up in Bodega Bay, California, Sonoma Coast, wine country. A lot of wineries in the area, an hour outside of San Francisco. Very tight Airbnb regulations, 44 units. All 44 units have water views. It was developed in 88. It had never traded until last year when we acquired this asset. The father had passed away 2 years ago. The son took it over, had poor management in place. It started severely underperforming. And he went to the broker and said, hey, I want to sell this asset, but I don't want my family to find out it's being sold. So the broker shopped it off market with a handful of buyers. We moved relatively quickly with this particular asset and a couple retrades, and we were able to close on it for 6.9 and a quarter after the seller credit. It's 44 units, about 140s a door, where the comps for unrenovated hotel comps in the area are trading for high 200s, even low 300s non-renovated. And so we bought it for 6.9 and a quarter. It appraised as is at 10.6. The appraiser actually went to our site to invest and jumped on an investor intro call. He's like, hey, dude, I appraised a lot of these hotels. I got to see what you guys are doing.
In the purchase price, it appraised for that much more?
Yeah, going in.
Wow.
Going in. And we got a bridge loan. And so they're looking at what's the as-is value, what's the stabilized value. So get this. We're doing a $2.2 million reno. It's almost done now. So I got a $5.9 million bridge note on that asset. We will refinance that deal at the end of this year. that thing will appraise between 14 and 16 million. Let's just say it appraises at 15. We'll pull out a new loan for 10. Okay. We'll pay off the $5.9 million loan. We'll pull out about $3.5 million out of this one deal, return that to investors. And that's just one hotel. So we're going to take it from 6.9 in a quarter to $15 million in about an 18-month span. You can't do that.
No.
In these other asset classes.
The only other asset class you could potentially think about doing something like that would be apartment complexes, large units.
And you saw that happen a little bit, like in apartment complexes, but this is like 10 years ago. This is before I was investing in real estate, but like I know of people that have been in the apartment game for a while, and I've talked to a lot of them on the
especially
podcast.
Right now, apartment complexes, it's the top of the game right now. Like things are coming down now because a bunch of syndicators came in and just kept way overpaying for properties because they had investors. Then we just got to turn over these properties, and so prices just kept going up and up. And now I'm seeing commercial properties coming on for sale. Like I just got a property under contract with my buddy Jason, 375 units, $68,000 a unit.
That's a good price. Where at? What market?
Yeah, Chattanooga.
Okay.
Chattanooga, and right now comps are at least 110. That's like the minimum. So we're getting a huge haircut because the seller passed away. The son and daughter have it now, and they just don't want it, so we're taking off them. But anyways, I potentially see something like that type of growth or just equity growth in apartment complexes, but you can't. I don't see it nearly as valuable because you're bringing in more revenue into the property. Am I right? That's why it's making more money, is because there's more revenue coming into these properties.
There's just a huge delta in the boutique hotel space because there's so many retiring baby boomers that own these old hotels. And because they're just so out of date, like the one that we bought up in Shelter Cove, California, Northern California, the beachfront, the 10 unit, that mom and pop seller, like that was the only piece of real estate they had ever owned. And all they were relying on was a direct booking site. They didn't know social media. They didn't understand OTAs. Like they didn't know what, hotels.com, booking.com. They didn't even know any of that stuff. And so because there's such a gap in terms of like the level of like how these boutique hotels that are underperforming, like how they're currently operating, and then how they can be operating if you use the right marketing, the right SEO, leverage influencer stays, and actually do a really good job with your brand and your redesign, that delta is huge. And that's why we're able to go in and 2x, 3x the value of the property. So to circle back to answer your initial question about like cash flow that's spinning off with these particular properties, boutique hotel is going to be a perfect blend of forcing a ton of appreciation. Think BRRRR strategy on steroids is what a boutique hotel model is. And then double-digit cash-on-cash return once you stabilize and refi into perm debt.
Well, on top of that, what you just said, being able to cash out a loan, a tax-free loan, to give your money back to the investors so they can do it all over again, or you could do it multiple times. But that is another amazing way, like you said, with a BRRRR strategy, you just keep doing it over and over again. But with that tax-free loan, it's like, why do I not keep buying more properties like this?
100%.
Are these properties hard to find?
They are very hard to find, but it's a numbers game. I would say it's a lot easier than multifamily to find these deals. I was investing in multifamily prior, and it was very competitive finding deals. A lot of money chasing the same thing. In the boutique hotel game right now, the competition is much, much lower. So it's a lot easier to find these deals. And the other thing I'll say is this is like the greatest transfer of wealth in American history is going down. 40 million baby boomers retiring in the next 6 years. 25% of the hotels out there are owned by these retiring boomers. Like I'm telling you, it's happening right now. 100% bonus depreciation, by the way, is coming back very soon. I got.
You think so?
I got a text by a couple of real estate.
I'm super pumped. That'd be great if it did.
Yeah, I got a text from a couple of real estate tax strategists that are in the know and very tightly connected to what's going on. And I got a text last week saying, hey, like it's about to happen. So, that's only going to bode well for real estate investors and entrepreneurs, but excited for the shift that's occurring right now.
What do you think about, do you have any inside knowledge about Doge killing off the IRS? Because that would be fun. It killed off the IRS.
I mean, look, I think, having 80,000 IRS employees, and taxpayers are spending their hard-earned income for a lot of those salaries. It's not just the IRS, but it's a lot of there's a lot of gaps and holes in the government. I mean, I worked at the government too.
You did? What branch?
Local
Local county government. I was working at the sheriff's office doing IT.
Yeah. So, I mean, there's a lot of gaps, as you probably know, a lot of inefficiencies within the government. I was an FAA,
Oh
air
my
traffic
goodness, it's so
controller.
inefficient.
There's a lot of controllers. I mean, I can say it because I don't work for them anymore. But a lot of those folks, they can't say it. Their hands are tied. But I'll say it. There's a lot of federal government employees that are drug addicts. They are alcoholics, and they are not allowed to work airplanes anymore. But because they're protected by the union, they are making $200,000 a year to like just work like remote office jobs to where, you know, I don't know how many hours a week they're working, and these are taxpayer dollars, and that's just one, branch of the government, right? That I saw so firsthand. So this is occurring, and so to answer your question about Doge and Elon and everything that's going on, I think is a great thing. We should know where taxpayer dollars are going.
Did you see that there is 8,000 new listings for homes in Washington, D.C. for sale coming soon
Mm.
because they're firing all these people. All these people from the federal government are getting laid off or not fired either way. And if you go into right now, I just did a social media post on this. If you go in there and you look at the properties that are coming soon, 8,000. It's just all over Washington, D.C. In this tiny little area, it's exploding. So what do you think about with everything from Trump to Doge to and Elon and all that stuff? How is that going to affect the Airbnb, not Airbnb, like the boutique hotels and even just the real estate market in general? Do you think this is going to have a ripple effect negatively or positively?
Oh, it's positive. I mean, look at what's happened over the last 36 months. We've been in a high interest rate environment. If you would have told me, or told any real estate investor 36 months ago, hey, the rate environment's going to more than double, and there's going to be not much effect to real estate pricing in most markets around the country. I'm talking about residential real estate in most markets around the country. Here in San Diego, the median home price has almost gone up over the last 3 years, right? And so if you think about why that is, it's because the fundamentals are good in terms of supply and demand. And supply and demand is what drives real estate. So if you look at the supply side, builders have pulled back. I mean, look what we had COVID in 2020. They pulled back then. And then in 2022, when the rate environment started doubling and we had all these rate hikes by the federal government, builders pulled back. And so new housing starts at an all-time low. Okay. Also, if you look at the demand side, it's never been stronger. The baby boomers are living longer than they once were. And so they're not selling off their homes and going into retirement homes as young as they once were. And then the millennials are buying homes for the first time. They're starting families for the first time. And then look at the Gen Zers behind them. The Gen Zers are moving out of their parents' house for the first time and looking for apartments to rent. And so from the demand side, it's never been this strong. And so I just think like you take the supply demand fundamentals out there, and it just really is telling. And so I believe, the theme for real estate investors has been all along over the last 3 years, survive to 25. And the Fed has come out. I mean, look at Q4 last year. They came out and said, hey, we're going to do a couple rate hikes. And now we got the greatest transfer of wealth in American history about to go down. Love them or hate them, but we have a real estate investor that took over office. The Republicans control the House. The Republicans control the Senate. 100% bonus depreciation is about to come back. There are going to be a lot of other real estate investor friendly and a lot of other business owner friendly policies that take place in these next couple of years. And so I'm telling you guys right now, anyone listening to this podcast, if you feel stuck right now, you're looking for that next thing, I'm telling you, it's happening right now. In addition to all that, 4.8 billion people use social media worldwide. That trend's not going to stop. You can learn more listening to a podcast today than you can going to a 4-year university. And so the ability to go out there and brand yourself, to market yourself, to come up with any idea, and to have it become a business that actually comes to fruition tomorrow has never been easier. And so if you're stuck right now and you're listening to this podcast and you're like looking for that next thing, I'm telling you right now, the opportunity is happening right now. And if this does not fucking excite you, this game truly is not for you.
I see so many amazing things coming for real estate investors the next 4 or 5 years. I mean, right now, especially, if you are a good investor, you're going to be able to find good deals. Because a lot of people ask me a question, well, Dustin, right now, prices are really high, interest rates are really high. Is it the right time to invest? I said, it's always the right time. But the best time was 20 years ago. The next best time is literally today. With that, there's never a bad time to buy real estate. People say, well, it's so high right now. Like, no, the timing doesn't matter. You don't wait to buy real estate. You buy real estate and then you wait. What you do, though, is you realize that it's not a bad time or a good time. There are good deals and bad deals. It's the deal that is going to kill you if you get a bad deal. And so right now I'm seeing so many good deals, but because I'm an investor, I'm in the game. A lot of people who don't see the deals are like, I just don't know what's going on out there, is because you're not an investor, not in the game. So if somebody was thinking, man, I really want to get a little bit more understanding of boutique hotels and even just try it, is that something that somebody should get into, or is that something that kind of tiptoe their way into, or is this something that like you jumped into it? Is it hard to get into doing something like that?
I would say this: if this is like your first time investing in real estate, boutique hotels is not going to be for you because it's very active. Okay. Now, if you're a busy professional or a business owner and you're like, hey, I want passive income, I want tax benefits, I want to diversify out of Wall Street, or maybe you invest passively as a limited partner in multifamily and you're like, I want to diversify out of that, that would be a good option. Diversify, invest passively into boutique hotels. Now, on the active side, I would only get into boutique hotel investing if you are an Airbnb investor. You already have 1, 2, 3 Airbnbs, because now you have the baseline fundamentals to operate a boutique hotel, or you have done a multifamily deal or two. Then I would say that you also have some fundamentals to go over and do a boutique hotel. Instead of tenants, you have guests. Instead of lease rates, you have ADRs, average daily rates. And so there's a lot of similarities that are not too different. But the opportunity is like the exit and really being able to drive a lot of appreciation of these assets.
Do you plan on exiting, or do you plan on holding these? Like, what's the exit plan on this?
So I'll give you the game plan with this fund, right? So I'm going to put 8 to 10 hotels in this fund, and we're buying in great locations, either on the water or off the water in California coastal. It's very hard to find these assets. And so I don't want to take all the risk of finding these assets, closing on them, and then renovating all these properties. When we shut down these properties and do these big renovations, there's no money coming in. That's the biggest risk. Contractors can disappear. These things can go over timeline. You can run out of money. There's a lot of different risks that can happen when you shut down these properties. And so I don't want to do all this and then stabilize these assets and then become a flipper and throw them back in the water. I don't want to do that. Instead, I want to hold these things long term. I want to refi these assets, pull the equity out. And I don't want to just refi them once, Dustin. I want to refi them a couple times. And so we have a 10-year target hold period in this fund. And so I will begin to refi a lot of these assets end of this year and into next year, and recapture a lot of that equity, the appreciation that we forced. And then I want to do a second refi in 3 or 4 years down the road. And I want to do that second refi and into a portfolio loan and refi all 8 to 10 hotels into a portfolio loan when the rate environment is likely going to be 200 basis points lower than they are today. Portfolio is because it's going to be a much larger loan amount. And so because you're refinancing into a larger loan amount, you're going to have a lot better terms and a lot more options for lower interest rate, maybe a little bit better LTV, leverage, all that good stuff. Because these lenders know, hey, one, it's a larger loan amount, but number two, is a lot less risk for them to lend to a portfolio, because it's a portfolio of 8 to 10 hotels. Now, if one underperforms, we still have the other 9 that will make the blended return solid. And so it's a lot less risk for them. And then that will be a second refi for us. And through those 2 refis, my goal is to return the majority of investor capital, and ideally, in an ideal scenario, return all the investor capital through those 2 refis, leaving the investors with no money in the deal and an infinite return on investment moving forward. We'll reap the tax benefits, we'll reap the cash flow moving forward, and then sometime by year 10, I'll look to exit. We have 2 exit strategies with our portfolio, and I talk a lot about this on my podcast, The Rich Drummers Report. Is the 2 exit strategies are this: we can exit individually because all of these hotels are individually branded. They have their own direct booking site. They have their own Instagram handle, so we can exit individually to individual buyers one at a time. Or the better exit strategy is to exit the entire portfolio altogether to an institutional group, to a REIT that is looking to drive a lot of economies to scale. There are also these REITs, these institutional groups. You probably know this as well. They're not looking for double-digit returns. They're looking for slow and steady single-digit returns, to where there's not a heavy renovation, there's not a big value add project, but they will pay a lower cap rate. They will pay a higher dollar amount per door for the economies to scale. And so I'm going to look to package up all the hotels together as a portfolio. And that will be our exit strategy 10 years down the road.
Yeah, that's fantastic. I love the idea of doing the refinance over and over again. I mean, in the end, when you think about all the cash that you have just sitting inside that property, if you sell it, yeah, you get the cash, but you get taxed on it. So if you do it a couple times over, like whenever I buy an apartment complex or even just a single family home, I try my best to just pull all my cash back out. So I have zero money of my own in the deal. So I'm just, like you said, infinite returns. So what are some, I guess, low lights? So like what are some negative things that can come from investing and being a part of these boutique hotels?
The biggest risk is what I mentioned. It's when you shut down these properties and you do these full renovations, because contractors can disappear. You can go over timeline. You can run out of money. There's no income coming in. The city could shut you down. That's the biggest risk. And so the investors that got into our fund early on, when it was a blind fund, they got in with a lot more risk because these assets hadn't gone through the renovations. They hadn't been stabilized yet. So the investors getting in now on this kind of back end, where all 5 of the assets are essentially stabilized and cash flowing, there's a lot less risk. But that is the biggest risk for this model.
So you said the city could shut you down. Basically, it could take your business license, so you can't actually operate as that. Is that what you mean?
Well, we're investing in California, right? And so there's a lot of bureaucracy and red tape here. And so if you don't do something right with a renovation, you could get stopped, right? And so, hey, you could get red tagged, and hey, have to go through a whole permitting process to even do like little minor things. And so that could slow down your renovation by a couple months. Meanwhile, you're bleeding cash flow, which obviously is never a good thing.
Man, this is exciting, and
Yeah.
especially the type of returns that you can get. Now on the return, cash on cash return that somebody put in, or just cash on cash, but like the amount of money that you can make in revenue from the properties, is like 8% return? Like how do you usually with your investors?
Yeah. So typically we have a preferred return, and we have 3 tiers based on the investment amount. And so tier 1, our minimum investment is $150K, and we do a 7% preferred return. So the first 7% that's generated in the fund each year, all of that goes to the investors. We don't pay ourselves until we meet that 7%. Anything above 7% is split 60-40, 60% to limited partners, 40% to us. We don't do waterfalls. I know a lot of syndicators do these waterfalls where their first hurdle is like 80-20 split, and then it goes to like 75-25, and eventually it goes to 50-50 once you meet like 12 or 13%, 14%, etc. I don't do that. I've done that in the past. I just feel like waterfalls are very confusing to explain to investors, and I feel like a confused mind doesn't act. I know a lot of general partners and sponsors that don't even know how to properly describe and explain their waterfalls. And so for us, we just do a preferred return with a straight 60-40 split. We have a target IRR of 17 to 23%. That's very conservative. We always want the investors to make their decision based on a conservative return profile, not an aggressive assumption. But in an ideal world, we return the majority, if not all, the investor capital back to the investors through the first couple of refis. They'd have little to no money in these deals. We cash flow them, reap the tax benefits, and then we have a massive exit sometime by year 10.
Man, so there's definitely a lot of moving parts. I mean, especially when you have a single family home, very simple.
Mhm.
Get a mortgage, get a tenant in there, very, very simple. When you have a commercial property, a lot more moving parts, especially the commercial loan. It's also something you have to worry about, commercial insurance. Like there's a lot more to do. And having somebody like you that has already been doing, especially you already have 5 properties, you said, or five full properties, and you're acquiring more to get to 10.
We're closing on our 5th one next week.
Okay.
And I'm going to put 8 to 10 in this particular fund, and then I'll close it, and then I'll start another one.
That's fantastic. Well, Rich, this whirlwind of amazing information. I see your vision of like in the next couple of years, like this is like the next big thing.
It's the evolution, man. It's happening.
It 100%
I'm
is.
speculating, and I'm always willing to be wrong, but I believe it's going to be the next big thing.
Well, it's paying off so far. So, I mean, it seems like you're not wrong. So I'm with you. Now, Rich, thanks so much for being on. Show people how they can find you. How they definitely listen to your podcast and reach out to you.
Yeah, check out my podcast. It's the Rich Summers Report. Top 1% podcast, business, real estate, a lot of self-growth. I bring on real estate investors, business owners, professional athletes, a little bit of everyone, but it's really good. And I talk a lot of hotel investing. It's the Rich Summers Report, Apple, Spotify. Also, look me up on Instagram at Rich_Summers. That's SOMERS. If you're interested in passively investing, go to summerscapital.com/invest. And if you're listening to this and you're like, hey, this sounds pretty cool, the boutique hotel thing, I want to learn how to do it actively, go to hotelinvesting.com. I have a really badass boutique hotel investing mastermind community with almost 100 members, 45 hotels owned collectively, action takers, people doing real live deals, partnership opportunities. That's hotelinvesting.com.
That's a solid domain name.
Yeah.
Hotel investing. My goodness, how long have you had that?
A year and a half now.
Wow.
It was just sitting out there available. We bought it for like $2,400.
That's it?
Yeah.
Oh my goodness, that's nothing.
Yeah.
That's a solid domain name. Well, Rich, this is fantastic. Everybody check him out. Check out the Rich Summers Report podcast as well. But Rich, thanks so much for having me on and having me come out here to San Diego, come hang out with you in person.
Dustin, I appreciate you, my man, and just the beginning, baby.